Welcome back to another Market Insight call, joined as always by Aaron. We're going to get into this pretty quickly because we have a guest we want to get to, but this is going to be the last podcast by the time this airs. Today is the 17th of October. By the time this airs, the election will be here in a couple weeks. So we'll start with some economic data that we've been seeing. Markets at all-time highs, which can feel scary, but those are feelings. We'll show the actual data. We'll close with politics and then get us off to that discussion with the founder of a GLD, the gold ETF. We'll start with inflation. So we'll look at the top right chart here where we're looking at what the most recent inflation CPI report came in last month. It came in a little higher than the estimates. The right-hand side is the estimates coming in at 0.1. Actual data was 0.2, which is trending down still from the trend we've had, but is a pause in really good numbers that we've been seeing. So this isn't something that's going to change the forecast in the medium short term, but a few more reports of this could be something that maybe slows down the market and pricing in a bunch of interest rate cuts that will show. The one thing on the bottom left that we're looking at is the Fed cares a lot about the gold one. That's PCE. It trends a lot lower than CPI, and so far it is still trending there, 2.25. The goal for them is to get that back down to 2. They're getting close, and we think they will start trending to what their forecasts are, which they're not saying they're going to get to 2% for another 18 months. So they've given us forecasts that they want to cut rates over the next 18 months, and as long as we're seeing this trend in inflation coming down, we're likely to get those cuts. We'll move to jobs. Most recent jobs number, we can see on the top panel that it's been above trend. The recent trend of adding jobs was low, about 100,000 jobs, and we got 254,000 added last month. Don't want to put too much stock into simple numbers of this. There's a lot of estimates in these numbers to come up with how many jobs were added. Of course, they could be political heading into an election. You want to show that trend up, but at least what we're seeing in the data, it looks good. And we can look at the bottom panel. That's the unemployment rate, back down to 4.1%. We saw over the last couple months it has been rising as those jobs added were not enough to gain the growth of the labor supply growing from immigration and people re-entering the labor market. Final number we wanted to look to is what is the market projecting the Fed to cut rates? When we look, this is a probability on the Fed funds trading, and this is looking out to December of 2025. We started this year, 24, with large expectations for cuts this year. That didn't happen. We'd had 2 cuts, 1 50 basis point cut, and likely 2 more. But when we entered the year, and we did a video with Jeremy Schwartz, the expectations were much higher than that. And we didn't get those, and the market is still much higher at the point we are today. So when we look at this, I'd say the difference was, at that time, you talked to equity investors, they didn't believe these numbers when they were saying there were going to be 7 cuts in 2024. Right now, I think they do. You talk to equity investors, we talked to George, we're going to air shortly after this. The market thinks 5 to 7 rate cuts are going to happen next year. So at least that's a potential risk that if we don't see that, there could be some more repricing.
Since we're referencing that, I did make the call that small cap and GLD or gold would be the great performing assets. So the year hasn't ended yet.
You got time to catch up. And in the short term, it does look good. But I did want to go to all-time highs that are not, it's not a bearish indicator. It's actually pretty bullish. So what we're looking at on this chart on the left side is just the number of all-time highs we've seen in 2024 alone. There's been 46 of them. You spend almost 7% of your time at all-time highs, which is not a small number.
No.
A lot of the times the market is at all-time highs. And the other measure that they pulled is how often does that all-time high support the floor, meaning the way they measure that is you don't go down any more than 5%. Well, that's only about 30% of the time. That's to be expected with normal 8 to 10% pullbacks. You're not going to be putting in a floor every time. But when we look to the right and we say, how is investing at all-time highs? On the green bars, you're going to invest at all-time highs. The gray bar is investing on any other random day. In the short term, the 3 to 6 months, the random day is better. But when you start looking 1 to 5 years out, you actually perform better investing at all-time highs, which would make sense. You're investing while the market's trending higher. Something good is happening in the economy. You're in a bull market. And what you see, the scare headlines on TV of markets are at all-time highs, it's time to sell, they don't like to tell you is employment's at all-time highs as well. We're seeing growth in employment. Corporate earnings are also at all-time highs, but earnings season just got kicked off a couple days ago. Not a whole lot to mention there, except the financials, which I've reported, look pretty good from the bank stocks. Inflation's at cycle lows for this bull market. That's something that's bullish for the market. It makes sense why we're seeing this rally. And Fed funds rates are high, but they're likely coming down. That's a risk. If inflation starts to tick back up and they don't start cutting rates, I think where the market is priced now, we'll have some difficulty. But at least now, like we showed, the trend looks good for those numbers. Let's get political. There are only 2 weeks left before the election. We know you shouldn't care what your financial team thinks about the election. We have strategies for no matter who wins, but let's just take a quick look and see where things are trending. We'll look at the Senate first in competitive races. Simple way of reading this, there are only blue seats on the chart, so at least as measured this way, not a whole lot of tough seats for the Republicans. Things look good in the Senate for Republicans. That's all we want to say about that. The House gets more complicated. The left-hand side, there are a couple red seats that are leaning or likely Democrat. And when you look in the Democrat toss-up versus Republicans, there are more toss-up seats for Republicans. So Senate looks pretty good for Republicans. House looks pretty good for Democrats. It's leading towards divided government, which is probably what the market wants to see.
That's what I always want to see.
Yeah, and polls are obviously at the presidential level changing every day. Short term, Trump did look good in some of the swing states the last couple weeks. And when we look at what would that do to asset class returns, well, the market was probably pricing in a little bit of that. He started rising in the polls. Well, small caps started rallying too. Now the financials we already talked about have done well and tend to make up a big part of the small cap index. So there's a little bit of both. Small caps doing well. Historically, they've done well under Trump relative to current administration. And this is an old chart. We're not trying to reinvent the wheel with this. I wanted to go back to the same chart that we used a couple months ago. It's a lot of data here. We're only trying to show a couple things. Both administrations had really good returns. Slight different differentials between what asset classes do well. And that is likely to happen depending on who wins. But at the high level, it's really something you wouldn't even feel.
Right. I would say that most of this isn't uncertain, and that the market's well aware of all of these, and it's pricing it accordingly.
And then the final thing to mention on politics is often on the right-hand side we showed here, I've showed it in different ways as well. Oftentimes just getting past the election and having certainty. There was a rally after both Trump and Biden were elected the next day after the election, 1% and 2% for Biden following the election. So there can be a lot of volatility in these last 3 weeks before, and generally there is a strong move in November after the election is certain, and then December's historically a fantastic month for the stock market.
I would say this is a much different, but exactly the same thing than it was 4 years ago when we were doing this podcast, and it was Trump and Biden.
Perfect. We'll close there, and we'll get over to our conversation with George from State Street. He is the Chief Gold Strategist at State Street, former director at the World Gold Council, one of the original founders of GLD, a $75 billion gold ETF. Just a little housekeeping to get out of the way. This content is for information purposes only. It is not financial advice or an endorsement of a specific product. We're not endorsing the Spider Gold ETF, GLD, but our guest was one of the founders, so we're gonna talk about it, and hopefully this disclaimer allows us to keep the video up.
Before we do that and we go to our guest, if you haven't subscribed, go ahead and do so. That way you know you always will be able to get content and great guests like that we're about to have.
George, thank you for joining us. This is going to be a fun podcast between two gold bugs and the founder of GLD, who does not call himself a gold bug. Thanks for being here.
It's good to be here. The reason I don't call myself a gold bug is that I've never had more than 20% of my own money in gold. I'm trying to be a disciplined investor at my advanced years these days. My advisor tells me that's the thing to be. But so never have more than 20%. I've never had more than 20%, but I've never had less than 5%. That makes me a believer, but it doesn't qualify me for your exclusive club of gold bugs, I'm afraid.
Well, let's start with how you got into gold. It's always one of those things that has to have a good origin story, and then lead us up to how you went on to found GLD.
Okay, cast your minds back, if you can, to the summer of 1972. And if it helps you to picture it, I wore my hair in an afro in those days, just like every other 25-year-old young man in London. And I was a reporter on a little financial magazine that disappeared a long, long time ago. The name doesn't matter. But the editor of the magazine came to the door of my office one day in August of 1972, and he said, "George, it's been 12 months since President Nixon closed the gold window. What do you think of that?" And I looked up at him and said, "I haven't the faintest idea what you're talking about. I don't know what that means." And he said, "Good, I'm glad you don't understand it, because I don't understand it either. I just saw a headline somewhere, and it occurred to me that if you and I don't understand this, then probably our readers don't. We're a monthly magazine. You got 3 weeks to deadline. Go find out about gold and write me a story." And here we are, 50 some years later. I'm still chasing the same story. Been involved in gold in one way or another basically all of my life. I wrote about gold mining companies for the Financial Times for a decade. I worked for a gold mining company running global supply demand research and making price predictions. Then that company was taken over. I moved to the United States to trade gold for Shearson. And then when Shearson closed down their physical metals trading operations, I went to work for the World Gold Council, and that's where GLD came along. My main job with World Gold was basically talking to governments and central banks around the world about the composition of their reserves, and of course the role that gold can or should play in those official reserves. And that was a fun gig to have. It meant a lot of travel, but it was a fun gig to have. But then at some point I was invited by my chief executive to be seconded to the investment division. Still do your regular job, of course, but we're going to second you to the investment division to try to find a way to revitalize the gold investment business. And I said, "Does it need revitalizing?" And he said, "Yeah, look at the statistics. On a regular basis, investment in small bars and coins, the traditional ways of doing it, accounts for about 10% of each year's gold demand. Another 10% goes into industrial applications, mostly in high-tech electronics and so forth, and a full 80% goes into jewelry. We are dangerously overexposed to one industry. Go fix it." And some years later, after an enormous amount of market research, we realized that what we needed was a gold ETF. And that is essentially the genesis of GLD.
Let's build up to a forecast for where gold's headed. What are the major drivers that you see that impact the price of gold?
A lot of different things, and the relative importance of these different drivers moves from time to time. We're talking about what's going on macroeconomically. Do we have inflation? Do we have recession? Do we have good economic growth? What do we have? We're talking about the geopolitical background. Are there wars? Are those wars likely to affect the prices of crude oil and therefore drive up inflation in the US? All these kind of things really matter. And are there any major emerging developments in the balance between demand and supply, the internal market dynamics of gold, if you like? So we look at all of those things, and as I said, the relative importance will change from time to time. But a couple of months ago, the team that I'm part of at State Street, the Gold Strategy team, actually it was in June, it was more than a couple of months ago now, we put our heads together and tried to decide what was the likely outcome for the rest of the year. What sort of trading ranges would gold be likely to be in? And so we had to look at all of these various different factors and the environment against which gold operates. But what we figured out back in June was that there were three major drivers that had driven gold prices up during the first half of the year, and we expected them to strengthen in the second half, which is why we were looking for somewhat higher prices than we'd predicted 6 months previously when we wrote our full year outlook. So the three major drivers that we identified back in June were very strong central bank buying, primarily from the emerging markets, because they're overweight in dollar-denominated debt and they're underweight in gold. This has been a trend for the last 14 years now, and it looks like we could well be on target for another record year or close to another record year for central bank demand. That has strengthened since June, which is one of the reasons why the gold price has gone up since mid-year. But it was also one of the drivers of higher prices earlier in the year. So central bank demand, absolutely crucial. The second thing we noticed was a big increase in investment in China specifically. And I think this is because the Chinese investor is vividly aware of all the problems in the real estate sector that have spilled over into the banking and financial sectors in the stock market. I think the Chinese investor in many ways is running scared of his own stock market, so he has turned back to what is the traditional alternative, which for him has always been gold. So we've seen a huge increase in gold investment in China in the first half of the year, slowed down a little bit during our summer, but it seems to be picking up again now that we're moving toward the end of the year. So that's been the second thing. And the third thing, we've also seen a revival in Western world investment demand. Now, this had nothing to do with the Chinese stock market, but I think this was based on the economic uncertainties we've been facing all year. Are we going to get recession? Are we going to get interest rate cuts? We finally got interest rate cuts now. The Fed has embarked on a sustained period of rate cutting. And I think that has been very helpful for the price as well. And of course, the geopolitical backdrop has also created a lot of uncertainty for investors in the Western world. So I think those are the three major drivers that we identified.
One of the questions I would have is, you came out with GLD, which really made it very accessible for investors, right? You could be able to trade gold without having to take physical possession. But since then, we've also had Bitcoin come on, which has had quite a run for a long time. It's certainly not as loved this year as gold is. How do you see that as a competing element for GLD?
Yeah, I'm not so sure that they actually compete. I think they do rather different jobs. Bitcoin's only been around for 15 years. I love to represent an asset with a track record that's 6,000 years long. I think that is long enough for me to make some significant, to draw some significant conclusions from. But given the evidence that we've got, Bitcoin, the returns have been very good. Not so good in 2022, but nevertheless, the returns on balance over the 15-year period have been very, very good. And I understand why people want to chase returns. That to me makes perfect sense. But what I always say to people, if you are going to chase returns by going for Bitcoin or one of the other cryptocurrencies, whether you buy it in ETF form or some other form, whichever way you do it, if you're going to do that, recognize that what you're doing is you are raising the volatility of your portfolio. You're adding risk to your portfolio. I understand doing that. I understand adding risk is a good trade-off if you want to get the returns. But what I always say to people is, if you are going to be increasing the level of risk in your portfolio, then have a good look at what you think of as your protective assets, your risk-off assets like gold, and consider maybe raising your exposure there to match the additional risk that you're putting in by adding the cryptos. That's broadly the thing that I say. I think that what gold offers you primarily is protection because of its diversification benefits, protection against inflation, protection against potential equity weakness, against currency weakness. And sometimes gold will offer you performance as well. At the moment, gold is offering you performance. The price is up 30% year to date. It's up more than 40% on a trailing 12-month basis, which I think is a more efficient way of looking at it. So gold is offering you at the moment protection plus performance. I find that a very powerful mantra.
How are you approaching, and what are your forecasts for inflation? Because inflation's been trending downward, and as you already mentioned, the Fed's cutting rates, and we're seeing gold prices move strongly higher on lower inflation as the market potentially prices in higher inflation, although that's not what's necessarily showing up in the fixed income markets.
Yeah, look, the relationship between gold and inflation is complex. I think a lot of people think that gold is a good predictor of inflation. It's not. I think gold tends to follow inflation numbers higher rather than being a predictor of inflation. Another thing, I think another mistake people make is they see an increase in the consumer price index or whichever index they're looking at to measure inflation, and they say, well, that's going up, so we should go and buy gold immediately. And I don't think that's a good idea, because I don't think historically gold has offered much protection against sudden sharp moves in the rate of inflation. Where gold comes into its own against inflation is when we have sustained high inflation. Let me define those terms. By sustained, I would mean a minimum of 2 years and preferably longer. And by high, I mean 5% or above. Now, we didn't actually have that in the most recent burst of inflation. I know the CPI reached 9%, but it was only above that level for a relatively short period of time. We were only above 5% for about 18 months. So I don't think that gold although gold was going up very nicely during that period, I don't think that gold was really responding to inflation. I think it was a whole bunch of other factors that gold was responding to. As for, is inflation going up or going down? I don't know. I don't think Jerome Powell knows either. He has said he intends to be data driven, and that to me is a very solid way of sorting out Fed policy. So I have no problem with that. I intend to be data driven too. I think it makes sense. The problem is it's very easy for all of us to overreact to 1 month statistics. And I think that is usually a terrible mistake to make. That what we need to be looking at is long-term trends. To me, the long-term trend in inflation is that it is stickier than anybody really expected it to be, especially on the Fed's preferred measure, personal consumption expenditure, which, 11 rate increases to a 23-year high in Fed funds has brought PCE down from just over 5% to somewhere between 2 and 3% currently. And the last few percentage points, that's always the hardest thing. It's like when you run a marathon, the last mile is the hardest to do. And I think that Jerome Powell is going to be cautious. This is why he's talked about he's going to be in sustained rate cutting mode probably through next year, but by the end of next year, he's probably going to have a pause. And the suggestion is that rates might still be as high as 3%. But he's likely to have a pause and see exactly where we stand as far as sticky inflation is concerned. So I think that, the jury's still out on that one. I don't have a prediction for where the inflation rate is going. I really don't. But I do think that inflation is likely to stay higher for longer than anybody expects. And I think that's why the Fed is going to keep rates higher for longer than anybody expects as well.
Whenever I think about inflation, I like to separate the expansion of the money supply from the effect it has on the CPI or PPE, right? Because you can expand the money supply and not necessarily see that in that. And when I look at gold as a relationship to money supply, I think that we are in an inflationary period for quite some time. Would you agree with that statement?
Yeah, no, I think we have been in an inflationary period for quite a long time. When we first started to see inflation come up in the statistics, it doesn't always show immediately in the statistic. When we first started to see it coming up in the statistics a couple of years ago, everybody from Jerome Powell through Janet Yellen at Treasury, everybody said, oh, it's transitory. We are getting high inflation. It will not last long. It is entirely the result of supply chain disruptions brought about by COVID. I think that free money had something to do with the high inflation as well. I think that putting interest rates to zero in 2008, 2009, in response to the global financial crisis, was absolutely the right thing to do. But 13 years later, to keep interest rates at zero was probably not the right thing to do. I think the Fed is very good at doing what it believes is the right thing to do whenever we have a crisis, but it tends to leave that right thing in for too long until it becomes the wrong thing. My concern at this point is that Jerome Powell might just keep interest rates too high for too long. He's talked about higher for longer, and that can very quickly turn into too high for too long. And he could still, I think, mess up the soft landing that everybody is now saying is with us, and that actually push us into recession. I think the Fed still is looking for what let me remember the quote, an extended period of below trend growth. And we haven't seen that. The economy's been going like an express train. The stock market's been going like an express train for way too long. And I think that, Jerome Powell is a little worried about that. So I'm a little concerned as to what the immediate economic outlook is.
As Austrian economists, we often have problems with the Fed. Monthly, we're tuning into a meeting where 12 people are setting interest rates and causing big swings in the market in the short term. So do you see or do you talk anything about returning to a gold standard? Is that any possibility in your forecast?
No, I don't tend to think about that very much because I don't think that there's a government in the world that would be prepared to accept the economic discipline that being on a gold standard implies. Essentially, if you're on a gold standard, then if you want to increase your money supply, which of course countries always want to increase their money supply, you want to increase your money supply, then you have to own more gold in order to back that increased money supply. And I really don't think that I don't think, as I say, there's a country in the world that would actually want to do that. There's a lot of idle chatter about possibly the BRICS countries wanting to go to a gold standard. I just don't see this as a serious possibility at all. Whether they invent a currency of their own, or I don't know what the plans are as far as that's concerned. There may be some clarity. We have a meeting coming up in Russia fairly soon. There may be some clarity might emerge from that. But I don't regard I kind of like the economic discipline, but I don't think that there's a government in the world that would be prepared to accept it. And if I were a government, I probably wouldn't be prepared to accept it either. I think that governments like the flexibility to pump money into the economy when they feel that it's in trouble, as it was in 2008, 2009, and again with COVID in 2020 and 2021. They like the ability to be able to do that without necessarily having to go into the gold market and buy this asset and drive the price up. So I think governments would prefer that flexibility in every case. I think it's really unlikely that we would ever go back to a gold standard.
Certainly, governments would be unwilling to go. I think I completely agree with that statement. They would fight tooth and nail before they were put back on that type of discipline. But at $34 trillion and growing, because they're not going to pull back money, right? It's always, we just need to, they'll find a reason to print additional money. And there's always a sound reason to do so, right? It's going to make the market go up. It's going to make economics move. But is that really the long-term bull case for gold? It's just the monetary policies that we tend to be on?
Certainly a component of the long-term bull case. I think no question about that. I've been hearing that our debt is unsustainable for 20, 30 years or more. It's kind of frightening to think that it has been unsustainable and keeps getting an awful lot bigger than it was before. It's disturbing. Unsustainable. If you are the dominant reserve currency as the US dollar remains, even if its role is gradually eroding, if you're the dominant currency, then people will always want to use your currency. They'll always want to buy your currency. They'll always want to buy your debt. And so that, I think, is what makes our deficits sustainable. But in the long term, the history says that every reserve currency eventually goes to zero, except the current incumbent, and that's only because it hasn't happened yet. The dollar, I think, the role of the dollar in the international monetary system and in the settlement of international trade debts is very, very gradually eroding. But I think it'll see me out, and it'll probably see the two of you guys out as well. The dollar dominance is not going to go away anytime soon. The pace of change in the international monetary system is glacial at best.
But to kind of wrap that up to your point, governments want to be able to have a money supply that's growing 5 to 10%, which is probably a good backdrop for gold. And you said, what's a reason they could do that? Well, if they're claiming that inflation's at 2%, they're comfortable with that money supply growth.
Absolutely. And
they're not that far off with their measures. I know we feel that inflation's probably higher than the metric you use, but the current metric they're tracking on a 12-month is at 2.25. So pretty close to their target. So that gives them a backdrop to potentially continue that growth.
I remember being at a meeting of central bankers in Switzerland. I forget which city I was in Switzerland, but there was a cocktail party, and all the central bankers' wives were invited. And because I wanted to get myself a glass of wine, I found myself chatting with a bunch of central bankers' wives. The central banking guys were all on one side of the room, and I was with the wives on the other side of the room. And we were just sort of chatting in general. And one of them, and I can't remember which central bank it was, and I wouldn't tell you even if I could, but she turned to me and she said, I agree with my husband that inflation is fully under control in our country. But I do wonder why the prices I have to pay in the grocery store keep going up as rapidly as they do. I think you're right. We don't know how to measure inflation. Alan Greenspan said the same thing. When Janet Yellen was a new Fed governor, we're going back, 1996, if memory serves. It was a long time ago. There was a Fed meeting at which she said, what is our target for inflation? And Greenspan said, if we knew how to measure inflation accurately, then our target would be zero. But we don't. So if we had to have a target, I would suggest that we might pick something around about the 2% mark. And she said, okay, so that's our target. He said, no, I'm not going to adopt that as a target. And if you decide to eventually, as a committee, then you'll probably regret it, because the public will expect you to keep to the target that you've set yourself. That's the way the public behaves when organizations such as the Federal Reserve set targets. And he said it'll be a very, very dangerous precedent to set. So here we are. We've got a target of 2%, even if I think Jerome Powell would admit too, we still don't know how to measure inflation accurately, which seems to me a slightly odd situation.
This is going to air 2 weeks out from the election, so I think closing with politics makes a lot of sense. When you're looking at possible administrations, changes, do you see much of a difference for the gold market under the other candidates?
That's a wonderful phrase, Chris, closing with politics. I'd like to close with politics and go on a long hike somewhere for the rest of the year, quite frankly. I don't think it's going to make an awful lot of difference. I'm listening very closely to the campaign rhetoric, to the promises that are being made. And my considered view at this stage, and we may well get an October surprise, we often do, but my considered view at this stage is that whoever becomes the president, we are going to have more spending and we're going to have higher deficits, so that these problems are not going to go away. As I say, the outcome of the problems is not imminent, but I think ultimately it's inevitable, and that is going to be dollar depreciation. And that, to my mind, is the only way in which we're ever going to be able to pay back all of this debt, is by essentially paying back in inflated, i.e. depreciated dollars. We borrowed in very strong dollars. If we pay back in weak dollars, that to me seems like it might be possible to do. So I think that, I think that the Fed is watching all of the things in the economy very, very closely, but I think they're also in the back of their minds is this whole question of deficits. And maybe they should leave a little inflation in the system, maybe even a little more than they might regard as their target, simply in order to be able to pay down some of that deficit.
Well, I think Chris said that, it makes sense to end with politics, but I never understood that politics makes sense. But I think you do. So, I really appreciate your thing. And I think we completely agree with your assessment. One of the things that we say is to be overweight equities and that you want to hold gold. And I think also when you think about gold, or at least the way that I think about it is, my great-grandkids are more likely to fight over the gold in my safe than a stock certificate of Apple, etc. So I want my Apple to outperform gold in my lifetime, but I think we know which one's going to be around, and you started the talk with a 6,000-year timeline. I think it easily has another 6,000.
If I were investing for the next 100 years, which at the age of 77 I am not, unfortunately, but if I were investing for the next 100 years, it would be gold and not the Mag 7, trust me.
George, thanks a lot for joining us. This was great.
Chris, thank you for inviting me. Aaron, it's good to talk with both of you. I really appreciate the opportunity.
Thanks, George.